You ever walk through a city, see a brand new skyscraper going up, and just wonder, who is paying for all this? Well, a lot of the time, the answer is a powerful and kind of mysterious force called private equity real estate. It is constantly shaping the cities we live in, so today, let's pull back the curtain and figure out how this whole world actually works.
Just to get a sense of the scale we're playing with, wrap your head around this number. The U.S. commercial real estate market is worth an estimated $26.8 trillion. Yeah, that's trillion with a T. It's this massive universe of physical assets that really is the backbone of our economy. And that leads to the big question, right? In a market this huge, how does the serious money find its way into these deals? I mean, we're talking billions of dollars here. You can't just hop on Zillow and buy a skyscraper. There are these complex, fascinating structures that make it all happen, and we're going to break it all down. All right, here's our game plan. We'll start with the big picture, then look at the two main ways to invest. We'll peek inside a real estate fund, and this is the fun part, see how everyone gets paid. Then we'll cover the different risk levels and finish up with the building blocks of capital. So, let's kick things off with Section 1, a 26 trillion universe, just to really get a handle on who owns what out there. Now, most of us have heard of REITs, right? They're the real estate companies you can buy on the stock market. But look at this. They only own about 1.7% of the whole market. Private funds, on the other hand, own almost 11%. That is the giant, often hidden pool of private capital that we're talking about today. Which brings us right to Section 2. If you're an investor, you really have a fundamental choice to make. Do you want to be the one calling all the shots, or do you want an expert to manage it for you?
So you could go direct. You buy the building yourself. You have total control, which is great, but it takes a ton of money. You're putting all your eggs in one basket, and you're the one getting calls at 3 a.m. when a pipe bursts. Or you can invest through a fund. You give up some control, yeah, and you pay some fees, but in return you get access to massive deals and a team of pros running the show. For most big investors, it's a no-brainer. The fund is the way to go.
Okay, let's move on to Section 3. Now that we get why funds are so popular, let's actually crack one open and meet the key players inside. So what exactly is a private equity real estate fund? Well, at its heart, it's just a vehicle. Think of it like a giant carpool for money. It pools capital from a bunch of different investors and uses that cash to buy, improve, and eventually sell buildings. And the legal wrapper for all of this is usually something called a limited partnership. Now, in that partnership, you've got two main characters. First, you have the limited partners, or LPs. They are the money. They provide almost all of the capital, like 90 to 95% of it. And then you have the general partner, or GP. They are the manager. They're the real estate experts who find the deals, run the projects, and they put in a smaller piece of the equity themselves. So you might be wondering, how do you make sure the manager is actually working for the investors? Well, there are two really clever built-in rules. First, these funds have an expiration date, usually about 7 to 10 years. That forces the GP to sell everything and return the money. No endless holding period. Second, and this is crucial, the GP has to invest their own money right alongside the LPs. They have to have skin in the game. So if the deal goes south, they lose money too. And all of this leads to the most important part. Section 4, how does everybody get paid? To understand this, we have to follow the money down a structure called the waterfall. Now, it can sound a little complicated, but I promise we'll break it down so it makes perfect sense.
A waterfall is basically the official rule book for splitting up the profits. Imagine cash literally cascading down, filling up one bucket at a time before spilling into the next. It's designed to do two things. First, protect the investor's initial money, and second, give the manager a huge reward, but only for truly great performance.
So here are the 4 typical steps. First, and most importantly, everybody gets their original investment back. No profits are paid until all the starting capital is returned. Second, the LPs, the investors, get what's called a preferred return, like a guaranteed 8% profit. Then, after a quick catch-up for the manager, we get to the real prize, the promote. This is where any leftover profits are split, and the GP gets a huge, outsized piece as their performance bonus. Let's look at a real example. The GP puts in $10 million, which is 10% of the total investment. But now look at the final payout. They walk away with $18.6 million. Here's the key takeaway. The total profit on this deal was $50 million. Of that profit, the GP gets $8.6 million just from that promote tier. That means they end up with over 37% of the total profit even though they only put in 10% of the money. That is a powerful, powerful incentive to knock it out of the park. Okay, so let's move on to Section 5.
Now that we understand how these funds are built, let's talk strategy, because not all funds are chasing the same kinds of deals. They all have different appetites for risk.
You can pretty much sort funds into three main buckets. You've got core funds. These are the safest. They buy beautiful, stable, fully leased buildings. Think low risk, steady returns. Then there's value add. These funds are like house flippers for big buildings. They buy properties that need a little TLC to boost their value. And finally, you have opportunistic funds. These are the high-risk, high-reward players. They're building brand new towers from the ground up or buying super distressed assets.
And for our last section, let's get into the nitty-gritty of how these deals are actually funded. See, sometimes a simple bank loan and equity just isn't enough, and that's where private credit steps in to fill the gaps. A really popular tool here is called a mezzanine loan. Now, the super important thing to get is what secures this loan. It's not the building itself, like a mortgage. No, it's secured by the ownership shares of the company that owns the building. Why does that matter? Well, if the borrower defaults, the lender can take over the entire company and thus the property way faster than a traditional foreclosure. It's all about speed and control.
And then you have this other fascinating hybrid, preferred equity. It's technically an ownership stake, but it acts a lot like a loan. The people who put in preferred equity get paid a fixed return before the regular owners, the common equity holders, see a single penny. It sits in this really unique spot in the deal structure, kind of blending the safety of debt with the potential upside of equity.
So, as we wrap things up here, it's really important to connect all these dots. These complex financial tools we've been talking about, partnerships, waterfalls, mezzanine debt, they're not just abstract ideas on a spreadsheet. They are the actual engines that turn these giant pools of capital into the concrete, steel, and glass buildings that define our cities.
When you get right down to it, private equity real estate is the invisible hand that's shaping our skylines. It's the whole mechanism for taking all this capital from investors around the world and turning it into the physical reality that we all live and work in every single day.
And that leaves us with one final thought. You know, as these huge forces like remote work, climate change, and new tech keep reshaping our world, which of these strategies do you think is going to build the cities of tomorrow? Will it be the safe and steady core funds, the fixer-upper value-add players, or the high-stakes opportunistic visionaries? It's something to think about.